Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at TeraWulf.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave in the comment section below.
So let's get into the analysis.
All right, so what's really jumping out here, the core reason we're even talking about this company now, is this massive shift that's happening. I mean, for investors, this is kind of the moment you look for. We're not talking about, a few percentage points of growth. We're talking about a huge inflection point.
It's a total transition. They're moving from, well, basically an infrastructure developer with a plan to a full-blown operational company that's making real money at scale.
And we have actual proof of this, right? This isn't just a forecast.
Exactly. And that's what makes it so compelling. Management put out Q3 guidance for 2025, and they're projecting revenue between $48 and $52 million.
48 to 52 million. Can you put that number in perspective for us? What does that jump look like?
Well, it's an 84% sequential increase from Q2.
84%.
84 in one quarter. For a company building out huge capital-intensive facilities, a jump like that is, it's staggering. It basically proves the model works.
Okay, so when you see growth that fast, especially in this industry where things can take forever to build, my first question is, where did it come from? It sounds like they just flipped a giant switch.
They flipped a couple of giant switches. And that right there is the proof of management's execution. Their big facility, the WULF den, started bringing in revenue back in July.
Okay, so that was the first one.
Right. And then the CB1 facility came online right after and started generating its own revenue in August.
So they finished construction, plugged them in, and the money started flowing almost immediately.
That's it. The speed is the key takeaway here. They're going from, pretty much a pre-revenue company to a 50 million plus quarterly run rate in under 4 months. The market always worries about delays with these kinds of projects, but this just de-risks that whole initial phase. The facilities are on, they work.
That speed is definitely impressive. It shows they can build, which is a huge variable. But building costs money, a lot of money. So if they're spending all this cash to get these computing centers running, we have to look at their financials.
Yeah.
How's the balance sheet looking as of, March 31st, 2025?
The necessary next question. And the good news is their foundation seems pretty solid. As of that last report, they were sitting on $218.2 million in cash.
That's a nice cushion. How does that stack up against what they owe in the short term?
Their total current liabilities were about $120 million, so that gives them a current ratio of roughly 1.8.
Okay, break that down for us. What does a 1.8 ratio mean in simple terms?
It just means for every dollar they owe in the near future, they have $1.80 in cash, or things they can quickly turn into cash.
So they can pay their bills.
They can easily pay their bill. It gives them a ton of flexibility, they're not scrambling. It's a really healthy position for a company that's expanding so fast.
Now, we do have to talk about how they funded all this construction in the first place. They've relied on selling shares, right? I think the number was around 384 million shares out as of May.
Yes, they did.
Does this new revenue change that strategy going forward?
This is probably one of the biggest changes for anyone thinking about this long term. Before, they had no choice. They had to dilute shareholders, sell more stock to pay for the builds.
But now
with $50 million coming in every quarter, they're on the verge of being able to self-fund their own growth.
Yeah, it's a game changer. Moving from investor money to their own profits.
It is. It means they shouldn't need to rely on the market nearly as much to build their next data center. And that is great news for shareholders who are worried about dilution. It's just a much more sustainable way to grow.
Okay, so let's shift to the competition. They've proven they can build fast. So what stops a bigger, richer company from just copying their playbook and pushing them out of the market? What's the moat here?
That's the billion-dollar question in any capital-heavy business. I'd say they have 3 main advantages that make it hard to copy them.
All right, lay them out.
First is their proprietary facility design. The WLF, Den, and CB1, they aren't just generic warehouses. They're custom built for high-density computing.
Because they're optimized.
Highly optimized. And for 2 very different things, Bitcoin mining and also high-performance computing, or HPC.
Now, proprietary design can sometimes sound like just, marketing speak.
Yeah.
How real of a barrier is that?
I think it's pretty defensible because of that dual-use optimization. Building a good mining facility is one thing. Building a data center for, say, intense AI workloads is another. doing both efficiently in the same infrastructure. That takes specialized knowledge that you can't just hire off the street.
I see. And that leads right into the second point, which has to be power.
Absolutely. Advantage number 2 is their power advantage. That's the biggest cost in this business, full stop. Getting cheap, long-term power is everything.
And it's not easy to lock in good rates these days.
Not at all, but they did. They secured long-term contracts for their big facilities ahead of time. That suggests they have a structural cost advantage over any newcomer who has to deal with today's higher energy prices.
Okay, and that brings us to the third advantage. And I think this is the really exciting one, the part of the story that makes them more than just another crypto stock.
That would be the dual revenue streams. You see, they're not just a Bitcoin miner. They are positioning themselves as an HPC data center.
Meaning they lease out their computing power.
Exactly. They lease capacity to other companies that need it for things like AI model training, machine learning, all that heavy-duty stuff.
Okay, so connect the dots for us. Why is being an HPC provider so much better than just mining Bitcoin?
It gives them stability. That leasing revenue, it's based on contracts, it's recurring, so it acts as this powerful buffer against Bitcoin's price swings. If the price of Bitcoin drops, they still have that steady leasing income.
And there's a second benefit too, right? Something about how the market values them.
Right. It's about multiple expansion. The market gives really low valuation multiples to companies tied to a volatile commodity like Bitcoin, but it gives very high and growing multiples to infrastructure companies that serve the AI boom.
Because the demand for AI computing is exploding.
It's surging. So by proving they can get that non-crypto revenue, they start to look less like a risky miner and more like a stable, high-growth tech infrastructure company. That's how you get a major re-rating of the stock.
It completely changes the story.
Yeah.
Okay, with that foundation, let's look at the calendar. What are the key events coming up that could really move the needle here?
The schedule is pretty packed for the next few months. We already had the preliminary Q3 results in late October. That was the big confirmation of the 84% growth.
The proof of concept.
The proof of concept. The full detailed earnings release is set for November 10th. That's where we'll see the nitty-gritty on profitability and margins.
And after that, I think you mentioned something about their capital structure changing.
Yeah, that's the mandatory conversion. It was announced in late November, and it takes effect on December 9th.
Okay, don't get too technical. In plain English, why does a mandatory conversion matter to an investor?
It matters because it cleans up their balance sheet. It forces certain complex debt-like securities to convert into regular stock. Big institutional funds, they love clean, simple capital structures.
So it makes them more attractive to big money.
It suggests confidence from management and makes them more investable, yes.
And what's happening on the ground in December?
Operationally, we've got the Q4 facility ramp. That means they'll be squeezing even more efficiency out of the new sites, maybe even adding more capacity. All of that translates into more revenue growth heading into 2026.
Which brings us to what feels like the biggest event of all.
It is the Q4 2025 earnings release, which should be around February 2026. This one is critical.
Why that one specifically?
2 reasons. First, it will show the full year results for 2025, but more importantly, it will include their guidance for 2026.
And what are we hoping to see in that guidance?
If that guidance confirms they're on a path to, say, over $200 million in annualized revenue, which the Q3 numbers suggest is possible, then the company's whole classification changes.
They graduate.
They graduate. They go from being a development stage company to a proven high-growth company in the eyes of the market, and that is when you can see that multiple expansion we talked about really kick in.
So the period between now and that February report is kind of the sweet spot for this re-rating opportunity.
That's the thesis, yes.
All right, we have to talk about the bear case. Let's pour some cold water on this. What are the 2 biggest risks here that are outside of management's control?
The top 2 are macro risks. Number 1, and you can't avoid it in this space, is Bitcoin price volatility.
Of course.
A huge chunk of their revenue still comes from mining. If the price crashes, their profitability gets squeezed no matter how efficient they are.
And the mitigation for that is the HPC business we discussed.
It's the key mitigation. That stable, contracted revenue acts as a floor. Plus, the current high price of Bitcoin gives them a big margin of safety to fund everything right now.
Okay, what's risk number 2?
Power cost and availability. Their entire business runs on cheap, reliable electricity. If their power costs were to spike, or if the grid became unreliable, that would be a huge problem.
A very real concern in today's world.
It is. But again, the mitigation is in their strategy. They proactively locked in long-term power contracts for their main sites. They chose their locations very carefully to manage this exact risk. So while it exists, they've done their homework to contain it.
So to sum it all up, the elevator pitch for an investor right now is really about this transition. You have a company that has proven it can go from 0 to over 50 million in quarterly revenue,
And it's backed by a strong cash position.
with a smart strategy to diversify into HPC, which kind of hedges against the wild crypto market.
That's the whole opportunity in a nutshell. The market might still be pricing this like it's a speculative builder, but the Q3 results show the execution risk is way down. That gap between perception and reality is where the opportunity is, especially before that big earnings report in February.
You know, that HPC component is what I keep coming back to. If the demand for AI just keeps growing like it has been, could that part of the business eventually become bigger than the mining side?
And that is the really provocative thought to leave you with. If the AI boom continues, that stable, contracted leasing revenue could become the main story here. And if that happens, they transform. They're no longer seen as a volatile crypto play, but as a core enterprise-grade data center, a pure infrastructure investment on the next wave of computing.
A fascinating story with a very clear timeline ahead. If you found our analysis useful and you want to keep up with stories like this, make sure you subscribe to Smart Wealth with Joshua for daily insights. We'll catch you next time.